Chapter 13 of Cost Accounting, we are going to talk about planning and budgeting. So again, budgets are very important to most companies. Normally that's a process that they go through every year and they determine, they create a master budget. A lot of times they'll break it down into departmental type budgets. And sometimes, again, they can even like hold their employees accountable to maintaining that budget. And then definitely have accounting personnel who calculate the variances and then research those, like why are they happening. So it is a very important part of accounting, I feel like, within a corporation. So the master budget, we've got three components. So our organizational goals, our long range profit plan, and then a short range tactical plan. Like how are we going to get to this long range plan in the next 12 months? So again, that the strategic long range one might be like 5 years or 3 years or something like that. Probably 3 years is more realistic. But then you want to check off so much this year as you're trying to achieve those bigger long range goals. So here again is a little diagram of kind of how it all comes together. But like I said, once we have that master budget prepared, we're always going to compare the actual to the budget and then investigate why things are not what we expected them to be. And then it can go along with people's performance evaluations. We especially say, like, you work in a production type position, you're going to be held accountable to what that budget is, and you would have to explain why you're going over that budget. If you're going under, it's probably good, so you would just get rewarded for that. So normally when we budget, we always start with estimating our sales. What do we think our sales are going to be? So again, there's a variety of different sources we can go to figure that out, but that's always the first step. So if we have sales staff and they give us an estimate, so they say, hey, we think in this example we're going to sell 240,000 umbrellas and they're $30 an umbrella, so that's $7,200,000 that we estimate in sales. Well, then if we are producing those umbrellas, we have to figure out, okay, well, if that's what our sales department says we can sell, we have to be able to produce them. So when we're looking at our inventory, whether it's, again, any level of the inventory, we always have our beginning balance plus whatever we purchase or transfer in during that period, less whatever is transferred out to either the next inventory level or transferred out as it's sold to cost of goods sold. And then that leaves us our ending balance. And then so down below here, again, to put that into the budget perspective, we have our units that are in our beginning inventory. What are we required to produce in order to meet that sales budget that our sales staff has estimated? Then we subtract out those budgeted sales, and that's what we have in ending inventory. So with rainy days, budget of 240,000 units, we want to have 30,000 in our ending inventory, and we currently have 20,000 on hand. So then we're going to have to produce 250,000 umbrellas. So again, that's kind of calculated out that way. So then we go back to say, okay, well, if we got to produce 250,000 units, what direct materials go into each umbrella? So again, it's given us our 3 yards of fabric, 2 pounds of metal, and then what do we have in our beginning inventory and our ending inventory, and then our cost per pound. So let me go back here. So the 250,000 units is what we need to produce, and again, the 3 yards of fabric and 2 pounds of metal. So 3 pounds of fabric plus our our ending inventory minus our beginning inventory. Then same thing down here with the metal. We need to make 250,000 umbrellas, 2 pounds of metal. We have a beginning inventory of 1,000. I'm sorry, we have a desired ending inventory of 1,000, and we have a beginning inventory of 1,000. So we would need 500,000 pounds of the metal, 755,000 yards of the fabric. Then we take that into, well, what does it cost? So it costs $2 per yard of fabric, $1 per pound of metal. So then these are going to be our direct materials budget in order to produce those 250,000 units. Then we move to labor. So how much labor does it take to make an umbrella? So it takes 0.25 hours of direct labor to make one umbrella. So then we'll multiply that by the 250,000 umbrellas that we need to make. We've got 62,500 of direct labor hours, and our average direct labor cost is $24 an hour. So that would be our direct labor cost. Then overhead, again, depends on how it's allocated out. So we've got the indirect materials and supplies that are at 15 cents a unit. We have material handling, which is at 20 cents a unit. Other indirect labor at 5 cents a unit. So that's all of our variable costs. Then our fixed manufacturing overhead, we've got our supervisory labor, maintenance and repairs, plant administration, utilities, depreciation, insurance, property taxes, and others. So we'll add those all together to get to our total fixed overhead. So then we bring those together with our materials, our labor, our manufacturing overhead. So that's our total manufacturing cost, which in this case, there's no ending work in process that they are planning. So that would be our cost of goods manufactured. We do have a beginning inventory of finished goods, and we have a desired ending inventory of finished goods. So then we would adjust those to then our cost of goods sold would be the difference. Now we also can have marketing and administrative budgets. I mean, those are also a big part of our financial statements. So then we've got sales commission on these umbrellas, $1.50 per umbrella. Other marketing costs that are 75 cents per umbrella that are variable. Then we have our fixed marketing, sales, salaries, advertising, and other. Then our administrative, these are all fixed. So then we've listed all those out, and we will budgeting then our administrative and our marketing. Then we put it all together into the income statement. So again, we expect to sell 240,000 umbrellas at $30 an umbrella, so 7,200,000. We just mapped out what our estimated cost of goods sold is, our estimated marketing and administrative expenses. So then that would be our operating profit. We'll estimate our taxes at 25%, and then that would provide us our net income. Then the cash budget, that's normally after we've calculated out our production budget and our income statement budget, we want to look at, well, how is the cash coming in? Because if our sales department says, hey, yeah, we have all the orders for all these umbrellas, well, what if we don't have the cash to buy the materials necessary, pay the employees necessary? So cash is still an integral part of budgeting, because again, we can't do it without cash. But we do need to consider like the timing of how we collect on our receivables, what's coming in cash sales. Are we going to need to borrow money from the bank or maybe issue shares of stock? So some of our cash distributions that we need to consider are our materials purchases, our manufacturing costs, our operating activities. Do we have required debt that needs to be paid down? Are we, because normally in our budgeting process, we also estimate, do we need new assets and how much have been approved? So when are those going to get paid for? When are we paying our federal income tax? Are we paying dividends? So all those things require cash, and we need to be able to map them out. And a lot of times we'll do it by month, like really in the industry, because you do want to know Some months, you've got seasonal things, probably with umbrellas the same way. There's probably certain times of the year they sell way more umbrellas, other times they don't. So breaking it down monthly is also very practical. This one, though, it looks like they're just doing it for the whole year. So we've got our collection on our accounts receivable, collection from employee loans, then payments to accounts payable, payments to our employees, payments for manufacturing overhead. Now notice we do not include depreciation. So remember what depreciation is. It's the allocation of an asset cost over its service life. But we've already bought that asset, so no money's leaving the building right now. So then we have to subtract depreciation from the manufacturing overhead, or no, like you're not subtracting depreciation on that cash budget. Same with marketing and administrative. There can be depreciation on office equipment, so just make sure there's no depreciation in that number either. Then payments to the IRS, to the dividends, to the long-term debt, acquiring those new assets, all of those are going to be cash out today. And then you'll be able to look at it to say, okay, do I have a positive ending cash? If you did not have a positive ending cash in your budget, then you'd have to know, well, we're going to have to come up with that money somehow. We're probably going to have to borrow it. Now, when we do break it out monthly, like I said, monthly is actually more meaningful, I feel like, to the businesses. Then we have to map out how quickly do our customers pay us. So sometimes they'll pay us in cash. Sometimes it's going to come in like next month for this past month. Are they taking advantage of cash discounts? And then there could be some debt that ends up getting written off. So if we have these 3 months of estimated sales, and then we're going to try to map the cash flow out for those. So then for January, we've got the 20% of January. So January, okay, so this line here, January sales, $500,000. 20% of that $500,000 is going to come into January as cash. The rest, not the rest of it, but 75% of it will then get collected in February. And then we estimate that 5% will not be collected. It would end up being bad debt, so we're not going to map that into our cash flow. Then do the same thing for February. 20% is cash sales coming in February. 75% are going out to March, and then we're not accounting for the 5% that we aren't going to collect. And then same thing with March. Again, we're not going past March, so this is only the 20%. So you just kind of tier it out as to when the cash is really going to come in, and then you use that in your monthly budget. Now your purchases for inventory and materials, normally those are going to be the same thing where there's a timing, like so much will be paid in the current month, so much is going to go out because they give us, again, terms of 30 days to pay. We may take advantage of cash discounts, which will reduce that price. So then we can tier those out as well. So if we have purchases of $120,000, 50% will be paid in that month, 48% will be paid in February, and then 2% is just being saved because we took advantage of cash discounts. Then the budgeted balance sheet. I don't believe that I've assigned any of these for your homework. The budgeted balance sheet is actually a harder concept, maybe even a higher level, like in a business finance type of a class. You would get into the real details of it, because they're gonna estimate, like, okay, well, if my sales go up, my accounts receivable are gonna go up. If my sales go up, inventories are going to go up. If I'm going through my budget and I have additional property, plant, and equipment that I'm purchasing, that's going to go up, which is going to increase my accumulated depreciation. Then you come over to your liabilities. Well, if my inventory goes up, I'm buying them from vendors, so accounts payable goes up. If my net income goes up, my taxes are going to go up. If I had to borrow money, like if I went through my cash budget and I knew I had to borrow to finance these new sales, again, my debt could go up. So all these things can go up in a percentage relationship with what's going on with your sales. But then the key is you still have to balance. You mean your balance sheet still has to balance. And then you might be able to estimate that increase in retained earnings because you'll have already done the income statement. So you know net income goes up. You're estimating what you're going to pay in dividends, which would reduce that retained earnings. So then the plug number to make it all balance ends up really going into like a debt line or again some sort of a financing line to say, well, if I really have these sales coming in and all these assets and liabilities change because of my sales, what does that do to my debt? When I was getting my master's degree in my higher level finance course, that was one of our projects that like you had a great product idea that you had orders forever. So like you could, if you could produce it, you would have a ton of money. But then the bank, because you're a startup company, said, well, hey, we're only going to give you $100,000 or whatever the scenario was. Well, then when you really worked out all of these budgets to say, well, if I really produced all these products and I had this kind of income, like then you got to the balance sheet, which was the last step, and you realized in order to make it all and support this high level of production that you needed, the bank, you don't have enough money. The bank is not loaning you enough money. So then you have to go back and say, okay, well, I can't fill all these orders. I can only grow so far because the bank is limiting me. So that's the benefit of that budgeted balance sheet. But again, it's a little high technical and hard to get all the way through that. But just have that big picture understanding. And then here again is another graph or visual showing you kind of how it all comes together. But we work out all of the production budget to go into our cost of goods sold because that will feed into our income statement. Our income statement is going to help create our cash budget. And then our budgeted balance sheet, again, helps us know if we're able to even afford this. Then retail and wholesale, because we are not creating the product, it's a little bit less detailed. We'll have a purchases budget to buy the inventory that we're going to sell. We'll still have our marketing administrative budget that will go into our income statement, which again would create our cash budget and our balance sheet. And then the same thing with the service organization. Again, just a little more detailed. The production companies where you're producing the product or the manufacturing companies, those will be the most elaborate budgets. But you do want to understand those because cost accounting is all about those kind of companies. And then again, there can be ethical issues in budgeting, especially if you are giving bonuses and performance evaluations based on meeting those budgets, because that gives people incentive to want to fake it or lie or pretend like they get there when really maybe they don't.